Hello and welcome to the Joe DeLisi Financial Advisor Podcast. Today we are going to talk about the idea or the question of, is the market, quote unquote, too high to invest in right now? Now, I got a lot of stuff to get to today, and unfortunately we've got 3 paragraphs of disclosures to read at the end, so we are going to just dive right in. So to the question, is the market too high to invest in right now? Well, I've dealt with this question since July 1st of 1998, which was the very first day I started as a financial advisor. It's probably a question I'll continue to receive until the day I exit this business, and one that makes complete sense to me as to why people ask it. At the core of all of our investing desires is the need to buy low. And based on this, then if anyone sees anything in the press or media about the market being too high, then no chance would you want to dump money into a quote-unquote market at that point. Now, there are 2 challenges to this. Number 1, it's too high for what time frame? So if you're a speculator or a trader or a gambler, then you're likely looking to flip shares of stock. And then markets being high would be a concern over a time frame of hours or days. But if you're an investor, then your time frame should be measured by years or decades. And then number 2, the second challenge, what market are people referring to? There are many markets out there. It's a repeating theme in what we talk about on this podcast, and if you're my client. But I'm going to address both these points today. So the first one is the easiest one to deal with, in my estimation, because there's a huge difference in speculation and investing. Now, I only do the second one for my clients. We only invest. We don't speculate. We don't gamble here. I'd rather lose someone's business than gamble with their money, or to allow them to gamble on their own, but on my watch. And I can best explain it this way. There are huge companies with millions of dollars, hundreds of millions of dollars at their disposal to try and time markets and to speculate on when to get in and out, and really in short periods of time, and yet hardly anyone can do it. And they certainly can't do it on an ongoing and a consistent manner. In the history of markets, really hardly any evidence exists that it's even possible. So we want to believe it's possible, but there's no evidence that would allow us to draw that conclusion. And furthermore, in the light of the lack of evidence, what's the probability that you or I or your golfing buddy could somehow actually do this very thing that the titans of industry can't? So I'd say that's a pretty low probability. And so instead, we're going to invest money. We're going to invest it for long periods of time. And in doing so, we now put the odds very much in our favor that we're going to make money. The evidence here will support that most people can make money doing this without being fancy or trying to time markets by simply investing and waiting and letting time take care of the rest. Now, if you agree with investing rather than speculation, then the price of the market today is mostly not relevant to you, because over time, that price today is going to look cheap to you in 10 or 20 or 30 years. So as an example, in 1998, the S&P 500 was about 2,100, and it's roughly 5,250 today. Even crazier, the Dow was at 8,629. It's over 40,000 today, roughly. So people asked me back then if I thought the market was too high, and they ask me the same thing today. And in the context of 10 years plus, no, the market is not too high. It's just right. But don't take my word for it. As always, I bring receipts. Let's prove it with numbers. So the numbers will prove that the market is not too high, but more importantly, it'll give you yet another chance to remember that your golf buddy is not telling you that there are dozens of markets around the globe and not just one. So can one market be high while others are super cheap? Well, of course so. I mean, does your buddy know that? Doubtful. So let's talk valuations. We're going to use PE ratios to do this, price to earnings ratios, which you may have heard of in the past, but let's review this quickly. So the price to earnings PE ratio is a financial metric. It's used to assess the valuation of a company's stock by comparing its current market price per share to its earnings per share. And it indicates how much investors are willing to pay per dollar of earnings generated by the company. A high PE ratio would suggest that investors are expecting higher earnings growth in the future. A low PE ratio may indicate that the stock is undervalued, or that maybe the company is experiencing difficulties. So let's think of it this way. Imagine you're in the market for a used car. Now, the price to earnings ratio is like considering the price of a car relative to its mileage. So just as a lower mileage would indicate the car has been driven less, it might have more life left in it, a lower PE ratio suggests that investors are paying less for each unit of earnings. So this would indicate, potentially better value. And conversely, a higher mileage car might suggest more wear and tear, just as a higher PE ratio might indicate that investors are paying a premium for a company's earnings, possibly expecting strong future growth. The historically normal range for PE ratios can vary depending on factors such as economic conditions, industry trends, investor sentiment. But as a general guideline, the long-term average PE ratio for the overall stock market has been anywhere between 15 to 25. And again, it depends on specifically which market we're talking about. So during periods of economic expansion and optimism, PE ratios tend to be higher as investors anticipate higher future earnings growth, leading to ratios kind of above the range. And then, on the other side, during economic downturns or periods of uncertainty, PE ratios may fall below this range as investors become more cautious and they would look for lower future growth maybe. Now, we typically want to consider investing where the PE ratios are low, as we would expect the future to be growth there. So let's look at some current PE ratios as of the beginning of this year, 2024, January 2024. So U.S. large companies, think S&P 500, it's roughly 24. And for context, again, anywhere from 15 to 25 is normal. And as recently as January of 2021, it actually stood at 39. So is 24 too high? Probably not, especially not if you're, looking out over the next decade plus. Now, what about U.S. small companies, a totally different market? This would be like the Russell 2000, and that currently sits at 27, almost 28. A year ago, it was almost 35. How about U.S. micro? This would be like the MSCI USA microcap. It's actually negative, almost 5, negative 4.72. European markets, they sit between 8, Italy, and 16, which would be France, according to MSCI Europe. And then finally, emerging markets sit between 8, Brazil, and 17, Peru. And that would, again, be according to MSCI Emerging Americas. I can go on, but we really don't need to. It's really obvious that based on the PE ratios, there are several markets here and around the world where PE is downright cheap. So I ask you, is the quote-unquote market too high? And the answer is, well, which market? We build portfolios that are massively diversified. And as you know, we tend to overweight the small and value companies. This isn't new. We're not chasing a hot hand. We simply build portfolios based on solid principles, and then we help you stick with it. Now, I don't know where markets go short term, but I can tell you that the numbers are not too expensive relative to PE ratios. So the lesson here isn't to buy what you think is low. The lesson is not to worry about what people are saying about the market because they really aren't looking at every market out there. Stick with your plan. Rebalance, ignore the noise. And that's it for today. Now our 3 paragraphs of compliance. Registered representative and financial advisor, Park Avenue Securities, LLC, Pass OSJ, 5280 Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-684-6400. Securities, products, and advisory services offered through Pass, member FINRA, SIPC, financial representative of the Guardian Life Insurance Company of America, Guardian New York, New York. Pass is a wholly owned subsidiary of Guardian Westpac Wealth Partners, LLC, is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California, insurance license number 0D34103. This podcast is for informational purposes only and not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Past, Guardian, or Westpac Wealth Partners, and opinions stated are their own. Guardian and subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. The material is intended for general use. By providing this content, Park Avenue Securities, LLC, and your financial representative are not undertaking to provide investment advice and can make a recommendation for a specific individual or situation, or so to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged, and one cannot invest directly in an index. 2024-172-137 expires April 2026. Diversification does not guarantee profit or protect against market loss. Equities may decline in value both due to real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in foreign securities may involve heightened risk, including currency fluctuation, less liquid trading markets, greater price volatility, political and economic stability, less publicly available information, and changes in tax or currency laws. Such risks are enhanced in emerging markets. 2024-172-137 expires April 2026.